Welcome back. Listen, if you're an executive, an investor, or a strategist navigating the insurance landscape right now, you are in the exact right place. Today, in this explainer, we're breaking down a massive structural shift in market momentum that literally just took place over a single week. We aren't just looking at a few isolated deals here. We're essentially looking at the brand new blueprint for insurance capital. $146 million. That is the volume of disclosed capital deployed just between July 26th and August 1st, 2026. But honestly, that's just the tip of the iceberg, because that figure sits alongside some major, undisclosed private equity moves. Across 5 very distinct transactions, we're seeing an incredibly tight set of connecting themes, and these themes signal exactly where the smart money is moving in this sector. Okay, let's dive into this. The macro thesis from this week is absolutely crucial for your strategic planning. Simply put, the era of reckless cash burn is officially over. We've entered a phase of extreme capital precision. We're tracking an institutional upgrade in specialty underwriting, the undeniable rise of AI-native distribution, and a really hard pivot toward discipline. So let's break down exactly how this is playing out. Pillar number 1, the institutional upgrade, highlighted by Cinven and La Caisse's acquisition of Optio Group. To really understand why private equity giant Cinven and Canadian pension fund La Caisse just acquired a majority stake in Optio Group, you have to look at the massive scale Optio achieved under their previous backers, Preservation Capital Partners. We're talking £460 million in gross written premiums. They grew from a single product MGA writing about $35 million in premiums to a diversified powerhouse across 15 countries with over 30 specialist products. That is a 13x growth in just 8 years. PCP achieved a clean, premium exit, completely validating the MGA roll-up model when it's backed by disciplined underwriting and systematic M&A execution. But here is the forward-looking takeaway for our market. It's who is buying them. You have Cinven, bringing deep, specialized expertise in the delegated authority sector. But more importantly, you have La Caisse, a massive pension fund with extremely patient capital. The entry of long-duration pension capital signals a massive shift. These specialty MGA platforms are no longer just quick 5-year private equity flips. No, they're being recognized as long-duration assets with structural growth and high returns on equity. Basically, they're becoming stable, long-term capacity partners. Moving on to pillar number 2, the profitability mandate, featuring Ominimo Series B. Ominimo, a Serbian-Hungarian motor InsurTech, just raised a €20.1 million Series B, led by the venture arm of the EBRD, and this deal just minted a unicorn, a $1.6 billion valuation. Just let that sink in for a second. Ominimo became Serbia's first ever technology unicorn, and they pulled it off in just 2 years of operation. They already hold a 7% market share in Hungary's motor insurance market. How? Well, by using hundreds of data points to price motor risk compared to the 5 or 6 that traditional carriers usually rely on. But, the valuation isn't just about their tech. And this brilliantly illustrates the structural rebuke to the last cycle of InsurTech. Think back to companies like WeFox, which scaled recklessly without underwriting discipline and, as we know, suffered massive restructuring. Omino achieved 12x premium growth in under 2 years, but they did it while remaining profitable in every single market they entered. Profitable at Series B. This is exactly what the market is pricing right now. The EBRD, along with strategic backers like Zurich, are rewarding trajectory, margin profile, and strict underwriting discipline. They are completely turning the page on that old growth at all costs era. Pillar number 3, capital velocity, centering on Tiptree's acquisition of Universal Shield. The timeline here is what you really need to pay attention to. On May 29th, Tiptree closed the $1.65 billion sale of Fortegra. Exactly 8 weeks later, literally barely enough time to clear out a corporate desk, they redeployed $100 million in cash straight into Universal Shield. This is the most circular, rapid capital recycling story we've seen in recent insurance M&A. Tiptree explicitly proved that selling a mature platform at a top cycle multiple wasn't an exit from the sector at all. Rather, it was pure capital optimization to buy into an earlier stage platform at a highly disciplined entry price. So what exactly did they buy for that $100 million? Well, Tiptree isn't just buying a specialty P&C company. They acquired immediate national market access. Universal Shield has 49 state licensing for both admitted and excess and surplus commercial lines. And that hybrid structure is huge right now, especially as admitted carriers heavily restrict exposure. On top of that, Tiptree acquired proprietary data-driven digital underwriting technology.
This means they can scale out specialty product lines infinitely faster than if they tried to build a traditional actuarial model from scratch.
Finally, pillar number 4, future-proofing distribution and risk, showcasing Soder Insure and Mapfre. We're seeing mature incumbents actively future-proofing their business using some highly novel structures. Take Soder Insure. They're stepping in to fill a massive gap that traditional insurers have frankly avoided. They just closed the first tranche of a $23.5 million Series B to provide institutional-grade digital asset insurance. Now, what's really interesting about this slide is the investor stack: Galaxy Digital, Coinbase Ventures, and Franklin Templeton. You've got crypto-native giants and traditional asset managers sitting at the exact same table. But the true genius here is the capital structure. Soder is holding Bitcoin and Ethereum on their balance sheet alongside fiat. By matching their capital to the exact currency of their policyholders' exposures, they've structurally solved the currency basis risk that has plagued institutional crypto coverage for years. It's brilliantly tailored for their DFSA-regulated target market.
And speaking of the future arriving early, Mapfre is making some serious moves. Just 8 days after acquiring safety insurance for over $1.5 billion, Mapfre took a 38.9% stake in Tugio, which is Spain's leading AI-native InsurTech. Why? Because the conversion metrics are simply undeniable. Tugio was the very first insurance app to integrate into ChatGPT for direct policy sales, and they're now generating more than 20% of their new clients entirely through AI assistance. Mapfre's dual-track acquisition strategy is crystal clear here. They bought safety insurance for scale today, and they bought into Tugio because conversational AI is now a commercially viable distribution channel for tomorrow, not just a fun tech experiment.
So let's bring this all together. What should you actually take away from this explainer? Well, the dots connect perfectly. Mature incumbents are heavily investing right now to secure their 2030 distribution channels. At the exact same time, massive institutional pension capital is arriving to professionalize and stabilize the specialty MGA space. And across the board, from the Balkans to Bermuda, the market is severely punishing unchecked growth and richly rewarding underwriting discipline and profitability. We have firmly left the era of reckless cash burn behind. As you look at your own balance sheets, your own M&A targets, and your own growth metrics moving forward, I want you to consider the overarching theme we've unpacked today. The capital is precise this week. Are you?